So today I want to talk about a common misconceptions that a lot of people I know make when it comes to investing. When it comes to investing, people think that they know that they have to buy low, sell high, but they think that they have to sell when things are falling and they have to buy when things are rising, and that is trying to time the market. Now, a lot of individual investors made this mistake. Even I made this mistake when I was starting out investing last year. So hopefully this video shows you guys a couple of studies that talk about how it can really dampen your returns and some solutions behind that. The first study we're going to look at is 2016 Dalba Quantitative Analysis of Investor Behavior Study. So this study looks at mutual fund investors, where they try to time the market for the period of 1996 to 2015. Okay, so this study, for the whole study, the equity investors, the mutual fund investors that try to time the market, as in thinking that the stock is gonna go down, so they further sell, but instead it went up, all these kind of things. They got a return of 4.7%, which is an average annualized return, not too bad. But the market in general had a return of 8.2%, which is twice as much as what these individual investors got. Now, bear in mind that if you're trying to time the market, you have to put in a lot more work. You have to study up on economics, you have to read the news every day, you have to look at charts, and all this effort goes into just 4.7% annualized returns. While if you have just put your money in the market, which could be an index fund, which is just a basket of securities that track the S&P 500 index, you wouldn't need to do all that research, all that chart looking, all that news reading, and you would have got a return of 8.2%. So let's look at another study that we look at day traders from Taiwan. So these day traders, it's a 2010 Berkeley study, found that the average trader lost 25 basis points, which is 25 over 100%, 25 over 100%, 100%, 0.25% of their portfolio daily. And the average day trader, actually 93% of them quit within 5 years. So just these two facts alone, well, it just goes to show that a lot of people have tried to time the market, and it doesn't work. Now, this is different from trying to beat the market, which means you get a higher return than the market. Trying to time the market is trying to foresee trends in the market, and not a lot of people have done this well. A most recent most recent example that I can think of is when I look at the price of oil. Analysts got the estimates all wrong last year and this year. So these are the top brains on Wall Street, and yet they couldn't accurately predict the price of oil for these past 2 years, which I read an article on the Wall Street Journal. So that's where my data came from. So if the professionals can't do it, I wouldn't really recommend that an individual investor that knows nothing about economics, finance, politics, try to time the market. Now, that being said, there are ways that you can beat the market without timing them. One of the solutions is through dollar cost investing. Basically, this is just investing a fixed amount of dollar every month into your retirement, into your portfolio, and you use that dollar or you use that money to buy more shares. And that is how you can catch the swings in the market. If the market goes down and you buy and it goes up, you make money. If the market goes down and you bought and it further goes down, and if you continue to go buying along every month while the market goes down, when it eventually goes back up because of productivity, inflation, innovation, you get to capture those gains because you were in the market. Now, the first study that talked about how the mutual fund investors got it wrong states that why gave a reason for that. Why investors are so bad at predicting trends? Well, they're not bad at predicting trends. If you try to reframe it another way. So here's the conclusion, and I quote directly: the data shows that the average mutual fund investor has not stayed invested for a long enough period of time to reap rewards that the market can offer more disciplined investor. So that just goes to show that if you are an investor, the best decision that you can make is just to put your money and leave it in the market and not try to buy and sell. Because when you do, more often than not, that is the wrong decision. The data also shows that when investors react, they generally make the wrong decision. So, voila, they do know the direction of the market. Just when they get scared and sell, that is usually when you have to buy. As John Rockefeller once said, the best time to buy is when there is blood on the streets. Like 2008, if you have bought then, you have enjoyed 3 to 4 times return on your money as the market overall raised. But if you bought individual stocks and basket of them, you could have well easily 10 times your money. Just like that. And if you bought during 2008, 1999, same thing would have happened. So for individual investors out there, I hope this video try to dispel some of the misunderstandings between market timing and trying to beat the market. And if you guys have any questions, like always, feel free to ask me. I would be glad to answer them to the best of my abilities. So thank you guys.